In the summer of 1997, currencies collapsed without warning. Stock markets fell in silence. Governments watched foreign reserves evaporate in a matter of days. What first appeared to be a regional disturbance became a systemic rupture that permanently altered how global markets judge emerging economies. The paradox was deeply unsettling. These were nations praised for discipline, rapid growth, and apparent stability. They followed the orthodox development playbook closely, yet they unraveled faster than many economies long considered fragile. The question lingered then and remains unresolved today. How did economies that seemed to do everything right fail first? For nearly a decade before the crisis, Southeast Asia had been treated as a showcase of modern development. Thailand, Indonesia, South Korea, and Malaysia delivered sustained industrial growth. Manufacturing expanded. Exports surged. Poverty declined across large segments of the population. Infrastructure projects multiplied. Highways, ports, factories, and financial centers reshaped skylines. Governments were viewed as competent managers of growth rather than reckless borrowers. International institutions cited the region as evidence that disciplined policy could overcome historical constraints. The phrase Asian miracle entered academic research, investment presentations, and policy debates. It suggested that development had discovered a repeatable formula: high savings rates, export-led growth, strong coordination between governments, banks, and corporations. Fixed exchange rate regimes played a central role in this story. Many regional currencies were tied closely to the US dollar. This was not a technical detail. It was a public signal of stability and commitment. For investors, currency volatility is often the greatest risk. By limiting exchange rate movement, governments appeared to remove that uncertainty. Returns became easier to forecast. Leverage became easier to justify. Capital flowed more freely as a result. Banks in the region borrowed heavily in dollars and yen, where interest rates were lower. Those funds were then lent domestically in local currencies. The spread generated profits. The risk was assumed to be manageable. The underlying assumption rarely faced serious challenge. Growth would continue at high rates. Exchange rates would remain stable. Foreign capital would roll over when needed. Debt would remain serviceable. As long as confidence held, the system reinforced itself. Capital inflows strengthened currencies. Strong currencies encouraged further borrowing. Rising asset prices validated optimistic expectations. By the mid-1990s, however, signs of strain were visible. Thailand's current account deficit widened year after year. Imports outpaced exports. Property markets showed signs of overheating. Credit growth accelerated faster than household income and corporate earnings. Real estate prices rose far beyond rental values. Equity markets priced in uninterrupted expansion. By 1996, Thailand's foreign debt reached roughly half of its gross domestic product. A significant portion of this debt was short-term. Much of it was unhedged against currency movement. These figures were not secret. They appeared in public data and international reports. Yet confidence in the broader system muted concern. Success created complacency. At the center of the crisis was a simple mechanical vulnerability. Currency mismatch. Borrow short-term in foreign currency, lend long-term in local currency. As long as exchange rates hold, balance sheets appear sound. But if the exchange rate moves, liabilities grow instantly. Revenues do not. This imbalance can destroy institutions within weeks. Fixed or semi-fixed exchange rate pegs required constant defense. Central banks intervened daily to maintain parity. They sold foreign reserves to buy their own currencies. This defense depended entirely on confidence. Once markets begin to doubt the ability or willingness of a central bank to defend a peg, pressure intensifies rapidly. Speculative attacks become self-reinforcing. Capital inflows had inflated asset prices across the region. Office towers, luxury developments, and industrial parks multiplied. Equity markets climbed far faster than underlying productivity. Risk was systematically underpriced. Stability was assumed rather than stress-tested. The absence of recent crises was mistaken for proof of resilience. The system appeared stable. In reality, it was fragile by design. When confidence weakened, capital reversed direction. Pegs strained. Debt burdens exploded in local currency terms. By early 1997, Export growth in Thailand slowed noticeably. Semiconductor demand weakened, competition intensified, property prices stopped rising, developers struggled to service loans. Speculators began to question whether the central bank could maintain the peg indefinitely. These doubts did not require conspiracy. They followed directly from observable data. In May 1997, sustained pressure hit the Thai baht. The central bank intervened heavily, spending billions of dollars in reserves. Public statements insisted the peg would hold. Privately, reserves were draining faster than acknowledged. Forward commitments masked the true extent of exposure. The defense became increasingly unsustainable. On July 2, 1997, Thailand abandoned its currency peg. The baht fell sharply. What followed was not containment but contagion. Investors reassessed the region as a single system rather than as individual economies. Similar growth models, similar debts, similar exchange rate regimes. Capital retreated with speed. Indonesia was next. The rupiah collapsed dramatically. Corporations with large dollar-denominated debts saw liabilities multiply overnight. Balance sheets imploded. Banks failed in rapid succession. Inflation surged. Purchasing power collapsed. Social stability eroded as prices rose and jobs disappeared. South Korea soon followed. Despite its industrial sophistication, the country relied heavily on short-term foreign borrowing. When rollover stopped, liquidity vanished. By November 1997, usable foreign reserves were nearly exhausted. Emergency negotiations began. The threat was not insolvency, but immediate inability to pay. Equity markets across Asia plunged. Credit froze. Trade volumes contracted sharply. What began as a currency adjustment evolved into a banking crisis, then into a full economic and social breakdown. The International Monetary Fund intervened with large rescue programs. Thailand, Indonesia, and South Korea accepted emergency financing packages. The conditions were severe. Fiscal tightening, structural reform, financial sector restructuring, weak institutions were closed or merged, subsidies were reduced. In the short term, austerity deepened the downturn. Unemployment rose sharply. Poverty increased. Social safety nets were strained. In Indonesia, economic collapse accelerated political collapse. Decades of centralized rule ended amid unrest and uncertainty. The crisis reshaped the nation's trajectory. The policy response became one of the most debated episodes in modern economic history. Critics argued liquidity crises were treated as moral failures. Supporters argued credibility demanded discipline. The economic contraction was extreme. Indonesia's economy shrank by more than 13% in 1998. Thailand and South Korea suffered deep recessions. Recovery took years. Globally, investors rewrote their assumptions. Emerging markets were no longer treated as isolated opportunities. Correlation replaced diversification as the dominant framework. Risk premiums rose permanently. Capital became more selective. Transparency, reserve accumulation, and exchange rate flexibility gained importance. Fixed exchange rate regimes lost credibility. Countries across the developing world shifted toward floating currencies and accumulated large foreign reserve buffers. This strategy was defensive rather than theoretical. It reflected memory shaped by collapse rather than optimism driven by growth. China observed the crisis closely. It chose not to devalue its currency despite pressure. The decision helped stabilize the region but imposed internal costs. Corporate behavior changed as well. Currency hedging became standard practice. Short-term foreign borrowing declined. Balance sheets became more conservative. Financial regulation tightened across much of Asia. Banks faced higher capital requirements. Risk management practices improved. Politically, governance structures shifted. South Korea accelerated market reforms. Indonesia entered a prolonged transition. Economic vulnerability translated directly into political consequence. The Asian crisis influenced future policy responses. During the 2008 global financial crisis, many emerging markets avoided sudden collapse by relying on reserves and flexible exchange rates. Memory altered behavior, but cycles did not disappear. In later years, low global interest rates once again pushed capital into developing markets. Credit expanded. Asset prices rose. Familiar patterns returned under new conditions. The underlying lesson remained unresolved. Growth built on fragile funding structures is not resilient growth. Stability enforced without flexibility creates the conditions for sudden failure. Markets do not punish intentions, they punish systems. Discipline on paper does not guarantee survival under stress. The 1997 Asian financial crisis was not an accident. It was the result of visible imbalances reinforced by shared assumptions and delayed responses. Financial systems fail quietly before they fail loudly. Warning signs are rarely hidden, they are often normalized. When capital mobility exceeds institutional capacity, volatility becomes systemic. This pattern repeats across decades and continents. Emerging markets changed after 1997. Global finance adjusted as well, yet the structural cycle remains intact. If markets continue to reward growth over resilience, are future crises already forming in plain sight?